Hi and welcome. My name is Eric Moberg and I'm covering the gaming sector here at ABG. And with that, I leave the floor with Erik Idén, CFO of Catena Media.
Good afternoon and welcome to this presentation of Catena Media. Today I will go through some of our latest financials as well as a general company update, primarily based on the fourth quarter where we recently held our report presentation. Looking into our performance here in the latest announced numbers, Q4 2019, we continued to improve and follow the trend we've seen now since the second quarter onwards, where we continuously have improved our revenues, ending the fourth quarter operationally with a revenue of 27.1 million euro. Gives us a growth compared to the third quarter, both in terms of revenue and EBITDA. In the quarter, we saw some positives, primarily related to our core brand, AskGamblers, that did an all-time high during the quarter. We had very good performance from our Italian sites, continued to improve as we were approaching a marketing ban during the second quarter. Since the regulations were put in place, we've seen continuing improvement in Italy. In the quarter, we also had some really good performance and improvements based on the actions we've taken over the past year related to our casino products in Europe that continued to develop according to our plans, which was very positive as we've invested a lot of time and effort into those products. We also continue to grow in the US, also according to plan. And on the positive side, we did not see any major impacts from the recent Google updates that we had during the fourth quarter, as we'd worked a lot with that over the past year with our sites to mitigate such effects. On the other side, negative in the fourth quarter, we did take some impairment adjustments in the quarter. We had some challenges in Germany related to our sports products. In UK, we did not manage to outgrow the third quarter in sports primarily. Japan did according to our plan. We had an umpire election during the third quarter in Japan that helped our numbers positively. We saw a little bit of held back here in the fourth quarter, but that was according to our expectations. Our sports sites in France did not relaunch as we expected late during the quarter, and related to that, we had very low revenues from the third development to the fourth quarter. We also in the fourth quarter saw an extraordinary adjustment revenue-wise in the US, affecting our numbers negatively in the quarter. That is to be seen as a one-time effect. If we look into our revenue development and the revenue growth over the past years, since 2015, we've seen this curve where we had a setback now during the second quarter, the first and second quarter in 2019. The trend actually started primarily related to our casino brands in Europe, where we saw a negative development already in the fourth quarter 2018, where we put a lot of effort into those brands, trying to turn that trend around, where we can see the positive effects here in the graphs. If we go ahead and look into our different revenue streams, we did have a good mix between our CPA revenue, cost per acquisition revenue, and our revenue share here in the fourth quarter being quite equal at 41% each. Our fixed fee revenue increased to 16%, primarily driven of an increased demand of banners and having banners on more than one website. And our subscription revenue stayed at about 2%. If we look into our margin development and cost development in the fourth quarter, costs were quite stable, as were our margin, our EBITDA margin, that stayed at 44%. We had the movement between some cost items in the quarter, as some costs increased related to direct costs due to some further investments in the US market, where we tried out PPC to see the potential effects and the traffic measures in relation to that. We did have some lower costs on operating expenses on a margin perspective in the fourth quarter, supporting the margin positive. If we continue down to our financial cost and financial net, where, as I mentioned here at the beginning, we did have some exceptional items in the fourth quarter, some related to redundancies, but the major ones related to impairments of intangible assets, where we did a assessment, as we do quite on a frequent basis according to the IFRS requirements. And that concluded in an impairment primarily related to our financial services segment, where the CGU cash generating unit were under impairment in the fourth quarter. We did also a adjustment and a transition over to the IFRS 9 expected loss model that we fully implemented during the quarter, giving us an additional one-time effect as non-recurring. If we continue down the financial items, we also had a fair value assessment, a fair value loss on the bond in the quarter. And for those of you who follows us, you get used to see these fluctuations depending on the underlying price development on the bond. If we look further down into our balance sheet and our statement of financial position, our debt and total debt were at the end of the quarter 151 million euro. And we had asset commitments of about 18 million euro in the balance sheet. And I will come back to the assets committed to in acquisition to elaborate a little bit further on those. So if we look at the development over the past year, going from about 82 million euros in asset purchase commitments at the beginning of 2019, we have continuously decreased those over the past year. That also means that we have taken over quite some large acquisitions coming over to us, where we can manage them and drive them ourselves operationally. That have happened over the past year. At the end of Q4, we had 18.1 million euro left in commitments, or not commitments, and where a large part of those already has been settled now during January in shares that has been press released to the market, and that is primarily relating to our US assets. So a large part of that remaining 18.1 million euro has already been settled, where the remainder will be settled in cash during the second quarter in 2020. That gave us a bit of a higher leverage compared to previous quarters here in the fourth quarter at the 3.46, primarily as a result of the decisions made during the last year, trying to avoid the too heavy dilution, where we decided to pay some of the acquisitions in cash. As for those of you who follows us know, we have quite a strong underlying cash generation in the company. And looking into the operating cash flow and the performance here in 2019, you can see we still run with quite a high cash conversion and a cash generation. As you can see, we generated about 38 million euro in operating cash flow in 2019, to be compared with 2018, where we did about 40 million euro. So pretty much at the same level. However, one have to remember that we did the IFRS 16 adjustment, where leases were moved to financial activities in the cash flow statement. But about 38 million euro in the underlying operating cash flow. Some brief wording around our refinancing. As we also have announced previously, we are in the process of reviewing and looking into the refinancing of the company. And as announced during the fourth quarter, where we stay to the same comments, we had a positive momentum at that point, and we continue with a positive momentum in that process. And we will get back to the market when we have more to say in this question. Briefly, related to our strategy and where we're heading at the moment, what we said is that we continue to focus on the organic growth as one of our key pillars moving forward. We adapt to regulatory changes. We focus on the geographical expansion to continue to grow our core and hero brands globally, as well as cost improvements within the company. And to divide those up to 3 different categories. We look into those on mature markets, where we see an increased amount of regulations, where we focus quite much on cost improvements to improve our margins. We don't expect those markets to grow as quick as our growth markets, where we see currently US, Japan, Italy, and some other countries in Europe, where we believe we will have a quite high growth trend going forward, with some operational improvements on those markets. And that takes us down to the markets into incubation, where we currently do investments for the future to be prepared. So to summarize this picture, we do take investments, we do take costs out of mature markets to reinvest into growth markets and markets into incubation, where we believe we will have a good growth trend going forward. Short term, some actions. What are we doing business-wise, and where are we with our operations currently? As I mentioned at the start, we had some challenges and saw some challenges within our sports business here during the fourth quarter. We are currently doing or having a huge focus on our sports products, driven from the UK office, primarily to narrow those down, to focus on fewer products, drive improvements where we prioritize search engine optimization ahead of cost efficiency, ahead of PPC spend, where we focus on cost efficiency to improve the margins on those products, and that also being a result of the refocus from PPC spend over to search engine optimization. Our casino brands in Europe, where we had quite some focus in 2019. We continue to focus on improvements on those products. We still have quite some actions to continue to work on, but we see effects of what we've done over the past year. And we've seen the trend now over the past quarters, where those products steady has continued to improve. We still have some legacy with us, some products that we are rebuilding, but all in all, this process and project continues with a good momentum. Other actions that we currently take is that we continue to globalize one of our core products, AskGamblers, where we translate the product into new languages to be able to expand the product into new markets. In the US, we do continue to improve, and we also continue to invest to be prepared for the new states to be launched within the coming 6 to 24 months. Where we take some investments to prepare primarily sites on the local and in the local states. And in general, as we've done over the past year, we have quite a heavy focus on our overhead costs to improve those, and therefore we're also focusing to improve margins over time. Some brief updates on the US and where we are in the US market. In the fourth quarter, we did see a launch in Indiana that went live during the quarter, ahead of what was previously expected. Pennsylvania, sports and casino operators are continuing to come live, where we see an increased numbers of operator being active on that market. Colorado passed sports betting referendum and is likely to go live in mid-2020. And we are preparing for new states to open up by being present in those states with content and with websites being ready for further states to launch during 2021 onwards. If we look into the first quarter of 2020, we see a lot of activities, and we expected a lot of activities where social casino is growing very strong. We expect Colorado to regulate, and as you can see, there is a lot of different activities ongoing on the US market where we follow that very closely to be prepared for the years to come. In January, we also released this trading update where we gave a forecast of our trading for January as a month, and we did 9% up compared to January last year. So 2020 Q1 started very well for us, which is of course very positive. So to summarize this brief presentation, we did grow our EBITDA. Our underlying business performance developed well in the fourth quarter. We started the year very nicely with the January growing 9% year over year. We continue to focus on our cost control activities to improve margins on mature markets, to reinvest those into markets in incubation and growth markets. And we are continuing with the refinancing activities with a positive momentum. So with those words, I'd like to continue to see whether we have any questions.
Yes, to start off with a couple of questions. If we start off with the Q1 trading update, could you sort of give us some more flavor how the exit of Q4 versus the beginning of Q1 was?
Yes. So if we look at the last year and especially from the second quarter where we saw our performance coming down to lower levels, since we've seen a positive trend, so our numbers have continued to develop positively since, I would say, and that was also what we saw in January. Normally, we expect the first quarter to be a little bit slower than the fourth quarter due to seasonality. But as January grew quite some from last year, it was a very positive development for us. I would say we also have to remember we are comparing ourselves to January last year where we had a slowdown or started to see the slowdown within our European casino products that actually took a hit in the second quarter. So that means we are meeting numbers that I would say still are quite tough in January. So we are very happy about the development we continue to see in that regards.
Fair enough. And in terms of Casino Malta, could you sort of like give us some more flavor on how the remaining part of the quarters has developed, and when do you assess that it will be feasible to assume that we will see year-over-year growth from this part of the business again?
I can't elaborate further on the first quarter and where we currently are, but what we have said when it comes to our products in Malta, and especially the casino products then driven from Malta, is that we do expect to see a growth late in the first quarter, beginning somewhere during the second quarter. However, given the current macro circumstances, it might put some light on that, but I would say in general that is what we said, and our expectations is still at that level.
And in terms of your sports betting vertical, given the recent cancellation of events, could you sort of give us any sort of color on what sort of effect that will have on the Q1 report from the events that has been cancelled, as we know as of right now? And also, I know it's quite hard to assess, but do you have any sort of feeling what sort of impact it will have on the full year for the full group's revenues and earnings?
So I won't elaborate on the future at this stage, but I can throw some light on the past and what we know have happened in the past. As you know, we are a digital company. 100% of our revenues is generated through the digital world. So I would say, looking back in time, and the last time we saw a settlement in the market in 2008, 2009, the type of companies acting on the internet did not see any large impact at that point. Then, of course, one can elaborate further on looking into our different segments. About 60% of our revenue comes from the casino vertical. We have about 35% generating from sports, and 5% being generated from the financial services segment. And I would say it is likely that looking at the market and the circumstances we see, that it will affect sports in some way. On the other hand, there are possibilities to redirect traffic to casino sites where we have the majority of our income. So I will stop there and not elaborate any further on the potential impact in terms of number, as the market is currently very, very volatile.
But if you just to follow up on that, if we just look at from what we know at the moment, the events that has been cancelled, do you have any sort of feeling in terms of sports betting activity, how much that will affect it? Will it be like a 10% decrease in activity, 20%, or a 30% decrease in overall sports betting activity during the first half of the year? Do you have any sort of feeling regarding that?
What I can say is that, of course, it will have an effect if sports events are being cancelled. But on the other hand, we do have there are still sports events run, and we see that people tend to bet on what is open and what is possible to bet on. So I would say you have to put a little bit of color into what's going on in the market and how it develops. At the same time, we are, as I said, able to redirect traffic. So we will get back to that in a period of time, and then to elaborate a little bit further on what we believe will be the consequences and potential positive effects, and if there are any negative effects that we see. But I can't elaborate further on that at the moment.
Okay, fair enough. And just the last question regarding the refinancing of the bond. It matures in 2021. Given the current sentiment of the bond market, what is sort of your thought process in regards of alternative refinancing solutions?
So given that process and the information we have provided, we have a bond that will mature in March 2021. It is about 11.5 months from now. I still believe we are in a good situation where we are at the moment in terms of that project, even given the market volatility we currently see. So other than that, I can't provide you with any further information, other than we are still happy with where we are in that process. Even given the current market situation, we don't see that the statements we've done previously will be changed in any way. We continue with the positive momentum, and that's what I can say at the moment.
All right, fair enough. And thank you all for attending, and thank you very much, Eric.
Thank you.